Well, thank you everyone who has already joined. So for those who don't know me, I'm Jordan Fry from the Prudent Plastic Surgeon. I am super excited to be joined on this webinar by Enpo2, who is the COO, and Bill McDonald, who is the CEO of My Financial Coach, who I got introduced to within the past year, and they really, I think, do such a fantastic job of just what their title says, coaching people and specifically physicians through their financial journey, and they have just a really well-aligned model and just a very kind of down-to-earth approach to thing, along with some very sophisticated tools at their disposal. So I've been super impressed with them, and I asked them to come and join us and talk about specifically investing in a tax smart way. So tax planning your way to wealth, which is always a hot topic and certainly the biggest expense for most people in general. And every physician I just about know is taxes. So this is such a huge bucket to talk about. So I'm so excited to have you guys here. I'll pass it off, I think, to Enpo first, and we'll kind of go from there. And there'll be lots of time for Q&A as well. So Enpo, thanks for being here.
Absolutely. Well, hey, thank you, Dr. Jordan. Really appreciate being here with everyone today. I'm really just here to give a little bit of housekeeping. Myself and Bill will be here to answer your questions at the end. Really excited to do so, especially because this topic often brings either questions that are personal in nature or general. If you do feel like you want a private answer to your questions, you can always message us using that chat directly. But we will go ahead and have all general questions that you would like answered at the end for perhaps the betterment of yourself and all your colleagues in that chat. So please, 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 whenever you have any questions, do not hesitate. Put it in the chat. We will get to it in the order received at the very end. Now, it is with great pleasure that I introduce your speaker today, Bill McDonald, who has a really great topic lined up for you. And I will let him give a little bit of a background on himself as well as my financial coach.
All right. Thank you, Empo. Good evening, no matter where you are this evening in the country. I happen to be sitting on the coast of Maine, which is in the Eastern time zone. And of course, we have people here in the West. So I'm going to start off, I'll give you a little background. I started My Financial Coach with a like-minded investor group about 6.5 years ago. My background is I designed executive benefit plans. I had a company that I founded many years ago. I sold it to a New York Stock Exchange company, and we designed plans. I actually was involved in designing the PGA Tour's deferred comp plan if you're an avid golfer, as I am. We did a lot of work in medical, Cleveland Clinic, University of Miami Medical, and a number of organizations like that. So I've always been interested in tax and tax strategies. I'm going to start off by actually quoting a few things from Dr. Jordan here in his book, Money Matters in Medicine. And I want to start, if you can go to the next slide, I want to start with some of the mistakes that people make. And we at My Financial Coach have identified these mistakes. Anyone who's made a lot of money in their life, because they're well educated, they spend a lot of time getting educated. Finally, they start to ramp up, make a lot of money. This evening, what I'd like to do is to get you to think about these, and maybe if you haven't made these mistakes, you can maybe avoid and learn from our experience. So the first mistake, the lesson of this mistake is it's not what you earn that matters, but it's what you keep. So you can make a lot of money, but if you spend a lot of money, you're not obviously putting enough away. And I see this, the second one, I can tell you, unfortunately, we have physicians in their 70s that are still practicing, and it's not because they love medicine, because they made a lot of mistakes throughout the year, chased a lot of shiny objects, and made bad decisions, and they're playing catch up. So let's make sure that if you're still building your career, that you start planning early. Bad spending habits. Income has nothing to do with wealth building. It's not what you make, but what you keep. So if a lot of what you spend is in taxes, and what we're going to talk about today is maybe how you can minimize and put some of those tax dollars towards some of the goals. And Dr. Jordan in his book talks about the margin, growing the margin between what you make and what you spend. So if you think about this, the amount of money that you earn and the amount of money you spend, the difference is a net margin. And that net margin, that's what we want to grow. And what you need to do there is your money needs to make money. So once you get your budget and spending habits in line, your income continues to grow, you minimize your taxes, you got to take that difference and you got to put that to good use. And we're going to talk about that in a little more detail. So most common mistakes continued here. The fear or perceived risk of investing leads doctors to commonly make one or two mistakes. They either feel that investing is too risky and they avoid it altogether, which obviously is a mistake. Or they feel investing is too complex, so they hire someone else. Hopefully, we're going to give you some education so when you hire that someone else, you're asking the right questions, you're getting the right information. We hear from a lot of people, those people in their 70s who made mistakes, that they hired the wrong advisor. And you've seen this with pro athletes. You know, they make lots and lots of money, but they put it in the hands of someone who mismanages the money and doesn't really do a good job. So you need to really understand the fees, the taxes, and the expenses that you're paying an advisor. And you need to know the difference between an advisor that calls themselves fee only versus fee-based versus advice only. Have you ever heard the commercial, "We make money when our clients make money"? Of course they do, because they're fee only. So as the market goes up, they're charging a percentage, but as the market goes down, they're still charging you money. And a lot of what we do with a lot of our clients is we help them understand the fees, make sure they're reasonable, and you need to talk about how do you cap those fees. These advisors are good, and but you just need to know what you're spending and how you're spending it. Advice only, and that's what my financial coach is basically charges you for the advice, doesn't charge you to manage your money. It's advice only. So here's an example. And this is one of the motivations why I started my financial coach. I've got a great financial advisor. He happens to be a tax lawyer, a CPA, a CFP, pretty bright individual. And his real expertise is managing money. Now, he helps me with a lot of other things, but he doesn't really do true financial planning. And you see this among a lot of specialists. So if you got a good insurance agent, they may be a CFP and they may do financial planning, but they have an expertise. In this example, you know, if you're dealing with like my person, they're really a money manager, they're a financial planner, but they only spend about 15% of their time there. So with my guy, I could never understand if he was working on his retirement plan or mine, because every time he'd make a recommendation, the recommendation involved a product. So I want somebody that's unbiased and unconflicted. So if you go to the right side, this is what a total financial plan looks like. You hit all of the elements. You start with your goals and objectives, because good financial planning takes budgeting, cash flow management, tax planning, estate planning, and then start to build your total financial plan together from there. So a recent survey asked, what was the number one financial surprise in retirement? Now, I would have thought it would have been inflation, outliving my money, and a whole host of other topics. It was taxes. I mean, how can it be taxes? I mean, people have paid taxes their entire life. They've deferred money their entire life, so they've kicked the can down the road. So they know ultimately they're going to have to pay taxes. How could this be one of the biggest surprises, if not the biggest surprise in retirement? But it was, according to this study. Another question was asked. They said, before retirement, how many advisors did you work with? And on average, they said 3. They might have had a wealth manager, maybe a CPA, maybe an insurance agent prior to retirement. Same survey asked how many advisors after retirement, and on average, the answer was one. It was the one that spoke to me about asset distribution and who understood that I'm no longer building a nest egg, but I must take what I have and I must live on this for the rest of my life. See, working with an advisor in the accumulation phase, they're earning money as they go along as you're building assets. But now, as you start to liquidate those assets into retirement, you need somebody who understands asset distribution and what we call asset location. We're going to talk about this later about asset allocation and asset location, which is probably more important. So no matter how simple a game is, if you don't know or understand the rules, you're bound to lose. So if you take, as an example, if you take someone who's earning about $200,000 a year and they're saving 20% of their income, they're actually wealthier than someone who earns $1 million, but they're not setting aside any dollars. So if you think about accumulating dollars, it's not what you're earning, it's but what you keep. So if income is not the scorecard, what is when you're measuring wealth? And as Dr. Jordan says in his book, it's really you take a look at your net worth. It's your assets that you're growing minus the liabilities, and that's your net worth. So let's go to a simple balance sheet on the next page. I don't know how many people actually take a look at their balance sheet, but you take a look at your assets. You got your market value, you got your 401k, your Roth IRA, your taxable investments, you got savings, et cetera. And you've got about 700 in this example of assets. And then you've got student loans for younger folks. You have home mortgage, you have credit cards, you have car loans. So your total liability in this example is $640,000. This person has a net worth of $60,000. See, up on the top, we look at the 401k and we look at the taxable account, but we haven't taken into consideration when you take distribution, what is the tax liability? And that's not showing up on your balance sheet. So it's really what you're worth after tax later in retirement, not before tax. So there's no easy fix for putting more spendable cash in your pocket. Taking on additional patients to earn more wages could actually make things worse from a tax perspective. So what's the answer? For most medical professionals, it's implementing financial and tax planning strategies that can lower your taxable income, reduce your overall tax rate, utilize available tax deductions and credits. And by the way, there's a lot of things in the new tax bill that you're going to be able to take advantage of that you might not think were available to you prior. And then it's maximizing your retirement savings opportunity. So when you think about most CPAs and tax planners are looking in the rear view mirror rather than through the windshield. I think most CPAs to me are reactive and not proactive. Every time I worked with my CPA, I would bring them something towards the end of the year. They never contact me during the year. It's at the end of the year, we start looking at ways I can take deductions and reduce things, but they're always just ready to file my tax return. I want to be more proactive throughout the year. So you need to make smart year-round decisions rather than waiting till the end of the year. A good example is you talk about tax loss harvesting. So most brokers and CPAs at the end of the year say, let's take all the gains in your stock portfolio, let's take all the losses, and let's use the losses against some of your gains. You should be doing this throughout the year. You should be thinking about if you had a major gain in January, why aren't I taking advantage and offsetting those? You're going to get greater returns throughout the year by working those gains and losses throughout the year. So you ought to ask about that if people are doing that. So doing proper planning can significantly reduce your tax liability and ultimately put more money in your pocket at the end. So how to create wealth from money that you already make? Well, you need to start by maximizing your employer benefits. Now, if you're your own employer and you're an LLC, an S corp, or even a C corp, You can have employer benefits, of course, and you're creating them. But if you think about the first step is to figure out your monthly expenses and create a budget. So the first thing we do, our CFPs that my financial coach do, is they say, how much money's coming in, how much money's going out, and what's that money being spent on? If you take a look at this chart and you take a $25,000 annual investment, and on the left-hand side, you pay your taxes first on personal investment alternative at a 6 and 8% return. You're actually investing after-tax dollars to begin with, and then you're paying income tax on the gains as you go along. On the right side, using pre-tax dollars to do it, and you're compounding money tax deferred. We're going to talk about strategies later, but the first thing you want to think about is, how do I minimize my tax by taking advantage of plans that are available? So if you're employed by an organization today, chances are they're matching your contribution. So you already got an investment return coming. I remember when my daughter took her first position, they offered her a 401k plan. And she asked me if she should invest in it. And I asked her if they matched. And she said, they give you 50 cents on the dollar up to 6%. And I said, how long do you have to be there? She said, 3 years. And I said, if you think you're going to stay 3 years, that's a 50% return on your money. So we're going to have a little fun in taking you through navigating and understanding tax implications. So let's talk about how people save for retirement. How do people save for retirement? I'm going to use an example here of a high income earner, and to have a little fun, make them age 45, and I'm going to call him Henry. Henry stands for high earner, not rich yet. But during my presentation, we're going to make Henry pretty rich as he starts to take advantage of some of the strategies that are available. So the first thing Henry wants to do here is to think about the tax deferred bucket. So he wants to put money into the tax deferred bucket. So what's available to the left-hand side of the bucket is a 401k plan where he can put $23,500. And once he reaches age 50 or older, he can go up to $31,000. New legislation, actually last year's legislation, he can put more money away if he's between the ages of 60 and 63. So they've come up with some more catch up. So if Henry also has 1099 income or locum work, he can go over and do a solo 401k plan. Now, you can't exceed the IRS limits on the individual contribution, but you can load up on an employer contribution and put away as much as $70,000 into that tax deferred bucket if you have that 1099 income. If you're working for an employer, you're kind of restricted a little bit by their plan. Now, if Henry has some 1099 income, that's a great opportunity to start putting money away on a tax deferred basis. And of course, SEPs and IRAs also would go into that tax deferred bucket. So if you work for a nonprofit organization, that 401k is a 403b, and you may be eligible for a 457b, which allows you really to double up. So you can put the 23,500 into the 403b, and you can put another 23,500 into the 457b. Now you have to be very careful with the 457b because in many cases, not all cases, but many cases, you're an unsecured general creditor of the organization sponsoring the plan, and you're paid out on a lump sum. So you're kicking the can down the road to get a big lump sum later on in retirement. So you may think about other alternatives, but it gives you a chance to double up. Now, some may be fortunate enough to have your employer put money into a 457F plan. It's usually only a organization contribution. And the downside is once you vest in that, you have to pay income tax, even if you don't take distribution. But again, it's a plan, usually a 3 to 5 year plan. So it really doesn't build much for retirement, but it does tax defer and it does qualify for going into that tax deferred bucket. So for those that have that 1099 income, or if you're in private practice, you can take advantage of plans like cash balance pension plans, where contributions can go as high is $480,000 a year. So there's really no limit on the amount you can be putting away into that tax deferred bucket. And we're going to see maybe strategies later on how we get money out of these buckets. So for Henry, again, if he's taking advantage of these tax deferred buckets, but then a major intervention happens here before he can do anything else, and it's called the IRS. Chris Rock, before he got slapped by Will Smith, came out with a quote. He said, "You don't pay taxes, they take taxes." Especially if you're an employee at an organization, you have all these withholdings, you don't even see your taxes. So as the sign says, when you put the IRS together, it's theirs. So our goal is to minimize taxes. Now, I don't mind paying taxes, but I don't want to leave the IRS a tip. So I'm always looking for ways of reducing my tax liability and putting those dollars to work somewhere else. So as we think about things we can do beyond the IRS withholding dollars, meaning what we do with after-tax dollars, most people take advantage of a taxable bucket. Now, a taxable bucket, you notice, is a little larger than the tax deferred bucket. So there's lots of investment options, has no government limit. So you might be investing in stocks and bonds and real estate, in private equity, could be brokerage accounts, mutual funds, everything going into this bucket. But you notice that little spigot down the bottom called taxes. So when you pull money out of this bucket in the future, we're going to have capital gains tax and maybe ordinary income. Now, if that bucket has mutual funds in it, they go in with after-tax dollars. You pick the mutual fund. Even though you don't sell the mutual fund, you're going to get a tax bill at the end of the year for what the IRS calls realized gains. So that manager may be turning over the portfolio inside the mutual fund. You never sold it, but they're turning it over and producing realized gains. So you'll get a tax liability for that in that bucket. So someone comes along for Henry and says, you ought to think about another tax deferred bucket called an annuity. So annuities are after tax. So you put after tax dollars into the annuity. They grow tax deferred and then the tax in the future. Now you have to be very careful with annuities. Annuities are good instruments, but there are different load structures. There are different riders that go on annuities, interest rates, and how annuities are structured. Very complex. I would advise, listen to the salesperson selling it to you, but have somebody else analyze and tell you the pros and cons of the annuity. But they are a tax deferred bucket. So for most of us, this is where we probably end up. We've got that tax deferred bucket with all those qualified pension plans. We might have purchased an annuity, but most of our holdings go into this taxable bucket. We're buying real estate, investments, we have brokerage accounts, we might invest in some private equity, and so forth. So everything we've done so far is called the accumulation phase above the line. So it doesn't matter what you're worth above the line. What matters is what you're worth below the line after taxes, which is called the distribution phase of life. This is when you're going to start to withdraw money from these buckets. So I want to go back to the taxes for a second. So when you think about taxes and you're putting money in those tax deferred buckets, you've got federal taxes, and depending on where you live, you have state taxes. You have Social Security tax. You've got your Medicare tax of 1.45. You've got that SALT tax, which is the state and local tax. And the cap was 10,000, but it just got raised to 40,000. And it got raised to 40,000 as long as your adjusted gross income is below 500. So you can take advantage of that if you've got it below. The new limit now is 40,000. So let's take a look at state income taxes and some of the planning opportunities here. So if you look at California, the highest marginal tax rate in California is 13.3%. You look at the gray states, there's no tax. A handful of states have a very high state income tax. So when you put money in those tax deferred buckets, you're not only deferring federal taxes, but you're also deferring state income taxes. Now, there are a lot of tax strategies that I've worked with over the years. In fact, I took advantage of one myself. So I accumulated a lot of money in these tax deferred buckets over my career in the state of California. So I deferred at 13.3, and I moved to Arizona about 5 years ago. And you'll notice that the tax rate in Arizona is only 4.5%. So there are special rules within the code, not many CPAs know, called the source tax provision that allows you to accumulate money in a tax deferred vehicle. And as long as you follow the rules in distribution and you move to a state with a lower income tax or no income tax, you never have to pay that state. So as an example, I worked on a major deferred comp plan with the CEO of a company up in Minnesota, and Minnesota's got a 9.85% tax rate. Now, he already set up his plan, so he was going to take distribution over a period of time for some of his accounts, but not all of his accounts. But he had a winter home down in Florida, and he told me that when he retired, he was going to move to Florida. I said, you need to make Florida your permanent residence. Because if you get down there, spend 6 months in a day, you're a resident of Florida. You need to vote down there. You need to do a whole host of things to establish residency. My tax advisor told me I should buy a funeral plot in Arizona to show that I'm established and I'm not moving. But that might be going a little bit too far. But he was able to defer all that money up in Minnesota and move to Florida and pay no income tax, state income tax on the distributions. Again, it works only for certain types of plans, but you should know about these provisions that are in the code. So it depends on where you live during retirement. That matters also. So you might accumulate in a high income tax state, but you may take distribution to the lower income tax state. And if you can qualify for the source tax provision, it could be a windfall as far as retirement dollars. The SALT tax, the state income tax. So this slide basically shows you, number one is the lowest property tax in the country. It happens to be New Mexico. And 50 is the highest, happens to be Connecticut. Connecticut's the highest property tax in the country. So if you look at California in the previous slide, it said 13.3 of state income tax. So if I'm accumulating money, and I'm deferring it, I'm saving. But if you look at Texas as an example, that was one of the gray states. Texas is 36th as far as property tax. Give you an example, my son lives outside of Dallas. He has a home probably worth about $600,000, even though they say it's worth $1 million. And he's paying $18,000 a year for property tax. But he's paying no state income tax. But he's earning a lot of money right now because he's still growing his business and so forth. But he's paying property tax. So someday when he retires, that property tax continues to go up. Now, some states, and you need to look into this, freeze the property tax rate when you retire, when you hit a certain age. Not all states, but some states. So where you live in retirement makes a big difference. Now, if my son would have the same $600,000 house in California, if you could ever find a $600,000 house in California, his property tax would be about 40 to 50% less. But he's paying more in income tax. So they're going to pay income tax or property tax. You need to really manage both. You need to manage your taxes. But now with the new SALT tax, if your adjusted gross income is less than 500, now you can deduct your property tax up to that 40,000 limit. So I wanted to add one thing to that taxable bucket that a lot of people are not aware of. Now, in those tax deferred buckets, you don't pay any ACA tax. So again, knowing how different investment vehicles are taxed is very important as you're accumulating dollars. So Henry's at his stage right now where he just turned age 55. And his advisor said, you know, Henry, you've done pretty well in life. and maybe you should kick back a little bit, and maybe even take early retirement. So you've got all of these vehicles that you've accumulated, and now you're 55 and you should think about taking distribution. Well, someone forgot to tell Henry about the 59.5 rule, because in those tax deferred buckets, if he takes any money from those tax deferred buckets before the age of 59.5, the IRS is going to hit him with a 10% penalty plus the ordinary income. So had he really planned on retiring at 55, he should have thought about a different strategy for accumulating money. Or if he's working with a good advisor, maybe he should start pulling from his taxable bucket first and leave those tax deferred buckets alone. And then when Henry reaches age 62, he's eligible for Social Security. And he finds out because his adjusted gross income, AGI, is over a certain limit. It's not a very high limit. He has to pick up 85% of that as taxable income. So he always thought his Social Security was tax-free. And even under the new bill, it sounds like they're really taking care of seniors, but not for this group. I mean, you're too high earners, you're growing your careers, you're going to have too much accumulation, too much AGI, you're not going to benefit. So 85% is taxed on Social Security. So now when Henry hits the ripe old age of 65, he and his spouse go to this website called Medicare.gov, and he finds out that based on his adjusted gross income at retirement, his premiums, monthly premiums, and his spouse's premiums are all factored in on what their adjusted gross income. So the more money you take on adjusted gross income on retirement, the more you pay in Medicare. Now, this is the 2024 chart. Think about if you're going to retire in 10, 15, 20 years from now, what is this rate going to be? So what we're trying to say here is you need to think about controlling your adjusted gross income in retirement to minimize the expense that we see here. That last RMD is what the IRS says now in those tax deferred buckets. You've accumulated a lot of money. They're sitting there growing tax deferred. And we think it's about time you pay some income tax. So the IRS says at age 73, soon to be age 75, you must take required minimum distributions. Whether you want the money or not, you need to take distributions. And again, that's something with your tax deferred accounts. It's going to happen, but that's going to impact your adjusted gross income. So it's going to raise your adjusted gross income based on everything that you're accumulating. And again, there are strategies to mitigate some of those RMD payments later in life. Okay, so Henry's now kicked back on the couch, a little depressed, and he's saying, okay, now I understand all these surprises. What should I have done differently, knowing that it all matters about what's below the line and not above the line? So we said, Henry, you should have set up a tax advantage bucket. So many of you have access to a health savings account. I think it's one of the best tax shelters out there today, or accumulation vehicles today. So under current law, a family can set aside $8,550 a year into that tax advantage bucket, into their health savings account. Now that's being used, obviously, you took a high deductible on your medical and you're using that to pay medical expenses. But if you're in good health and you continue to accumulate that bucket, you can take it all the way into retirement. You can use it to offset your Medicare drug and supplement policies. And if you want additional income from that bucket, you can actually start to withdraw like an IRA and have to pay tax on it at that time. But you're growing this bucket tax deferred. You're investing that bucket just like you would, say, an IRA plan. A lot of people should look at their health savings accounts, especially younger individuals today in good health, or a family with very few medical expenses. You save a lot on premium on medical, but you take the difference and you put it away. Now in 2026, that's going up to $8,750 with the extra $1,000 for people over age 55. Now, during Henry's time, when he was accumulating money tax deferred, which is a good strategy, he should have been thinking about converting some of that over to a Roth plan. Now, many of you probably know you put after-tax dollars in the Roth, then it grows tax deferred and it pays out income tax-free, which doesn't impact your adjusted gross income. So they should have been thinking about doing some conversions. And at My Financial Coach, our CFPs actually can model out when the best timing is to do some of these Roth conversions. Or if your employer offers a Roth option today, you might think about, should I pay my taxes today and be tax-free in the future? So if you think taxes are going up in the future, could be a good strategy. But again, we can't give advice, to in a call like this until you look at an individual situation and what's best for you. And then in that bucket also, there's a number of insurance contracts that are being used. Now, this is not whole life insurance. It's not a traditional insurance, but a lot of high net worth individuals are using a cellophane wrapper. It's called life insurance, very thinly priced. Inside of it is a bunch of investment options. It's usually 100% cash. It looks like a Roth. It accumulates money tax deferred and it pays out tax free. So people are using that strategy to build this bucket. So if you haven't learned anything from this slide, I want you to write down non-reportable income, because everything coming out of this bucket drops below that line and it's not impacting your adjusted gross income. That impacts your Social Security, impacts your Medicare, and impacts your taxable income. So having a strategy to maybe get some assets that ultimately will pay out tax-free is a good strategy. So even for those that have extra income or 1099 income, or a spouse with 1099 income, and they can set up that cash balance approach, there are strategies that can convert those buckets down below the line to be also tax advantaged. So we've all learned that asset allocation is investing in different asset classes to reduce investment risk. Actually, Markowitz and Sharpe won the Nobel Prize for modern portfolio theory. And their theory was, if you minimize your risk by going small cap, large cap, international, et cetera, in building an asset allocation model. In 2008, when the market took a crash, I took a big hit on my investment portfolio, but I stayed with my asset allocation and it grew back over time. And even the beginning of the year, when everybody was panicking, when the market was down, I stayed with my asset allocation. Versus thinking about asset location. Asset location is investing in different tax locations to reduce tax liability risk. So this is what you should be thinking about. So you've got your bucket of tax deferred accounts that's going to pay out in ordinary income. You've got your real estate investments and so forth that are going to pay out in capital gains. And you should start be thinking about building a tax-free bucket, ultimately that tax advantage bucket for payout. So here's an example of a doctor and spouse, Scott and Mary, and they've hit retirement age and they want to pull out $350,000 a year from all of their assets. Now they focused more on asset allocation and building their assets, and they weren't focused on asset location. So as you can see from the top part of the slide, they're going to pay income tax at different levels, and they're going to end up on that $350 paying $72,000 a year in taxes, or about a 21% effective tax rate for pulling money out. But if they would have thought about asset location, they could have had some ordinary income at the beginning, they could have had some capital gains, and they could have had some tax-free income, and they can reduce that effective tax rate in retirement down to 11.2. And everything coming out of that tax advantage bucket or tax-free bucket here wouldn't be subject to the AGI, et cetera. So again, think about asset location as well as asset allocation. So minimizing or eliminating taxes when selling an appreciated asset. So you might have an asset in that taxable bucket that has grown over the years. You might have bought Microsoft when, at the beginning, or Apple, or any one of the AI stocks today, and you've got this appreciated asset, and you go, how can I get that appreciated asset to minimize or eliminate my taxes? There are many strategies, and maybe in future sessions, we'll go into a lot more detail on these, but charitable remainder trust, charitable LLCs, deferred tax saves, deferred comp installment sales. So I'll give you an example of my own personal situation. So I sold a company years ago to a New York Stock Exchange company, and part of the payout to me was cash and part was their stock. Their stock came to me with a zero basis because I started my company from scratch and I had a big gain. So I went to my CPA and asked my CPA, what do I do? He said, pay your taxes. And I said, I live in California. So that means capital gains federal and capital gains state. So through my own research, I found a charitable remainder trust concept where I took part of that stock and I took the value of it and I put it into a charitable remainder trust. I got a tax deduction on the beginning. And I also was able to liquidate the stock, diversify it into a balanced portfolio without triggering any tax liability. And my wife and I withdraw 7.3% of principal and interest for the rest of our lives from that trust. And we set up a family foundation to be the beneficiary of that charitable remainder trust so that we make our children good citizens in the community. I didn't do it because I was philanthropic. I did it because I wanted to minimize my taxes. And as I get older over the years, I'm more philanthropic with the approach and so forth. But there are many strategies out there that people don't think about. People think, well, charitable remainder trust, I need the money. I need that money for my retirement. I don't want to give it away to charity today, but this, I'm not giving it away yet. So I'm earning, the dollars are growing inside. It's creditor protected. I take a distribution every quarter from that trust, and it changes every year based on the balance. And ultimately, it's going to go to a good place for charity. So think about appreciated assets, and here's how you get out of some of the appreciated asset. You got real estate. A lot of physicians and medical professionals are investing in real estate. So you keep doing these 1031 exchanges. How do you get out of them? Ultimately, there are strategies that can help you. So navigating and understanding your employer benefits, consider Roth versus pre-tax options, like I talked about going along the way. Take advantage of any matching contributions to your 401k or health savings account. Balance your spending versus your savings. Balance debt pay down versus savings. So these are all the helpful hints that you should be thinking about in understanding how taxes, understanding how to be tax efficient with the investments that you're choosing. So in conclusion here, think about diversifying your tax strategy, managing your income and taxation in retirement, and thinking about, even though you might be 25 years from retirement, think about it today about how those dollars are going to be distributed in the future. Now think about that asset location, and this helps you manage longevity risk. So as Empo said, we covered a lot today, and there are questions. I know I've seen some questions come through already that we can answer, but if you have questions beyond this, you can email them to us. Now take this QR code, and if you hit on that QR code, you'll be able to pull up some information on My Financial Coach, what our planning process looks like, and at no obligation, you can set up a call with one of our CFPs and just chat about your situation. They can answer some questions for you today, and then you can see if it makes sense for what you want to do. So with that, Empo, why don't we go to the questions?
For anyone who does have any questions, please put them in the chat. Everyone will be muted for the remainder of this session, but we will go ahead, of course, and unmute Dr. Jordan. Perhaps he can help me with reading out some of these questions, and then either Bill or myself can answer them.
Awesome. Yeah, that was a real tour de force, Bill. Thank you. Extremely, extremely helpful. And what I appreciate most is very actionable with tidbits you can follow along. I'll ask the first question we have in here, which is about the HSA. Can you use the money in the HSA account for Medicare Part D payments?
For part B,
D, like dog.
yeah. I don't, I think you can, yeah. Is that correct? I think it's B and D.
You have to remember that your HSA is, as long as you can, as long as your CPA signs off on it, you could technically use it for many different things. It's very important for you, of course, to get a good CPA who is willing to say, yeah, that's definitely a good medical use of those dollars.
Awesome. Another question just popped in, but I have a quick one that I'd like to ask because this is something I'm always considering. When, Bill or Enpo, do you think is like, what are the best times that physicians should be considering Roth conversions? Like, what are the events or life stages where that makes the most sense?
Ampo, you've done a lot of these recently. Why don't you take that question?
So there's the right answer, and then there's what I see a lot, and then there's everything in between. I think usually, someone will be afraid, like, oh my God, I think that, like, look at our national debt. The taxes are going to go so crazy. We're above 100% of GDP to debt. I got to make sure to convert as much as I can, or make Roth type contributions. Just pay the taxes now, not worry about it. And I think that really it's a matter of going to the numbers. And what you want to do is you want to make assumptions, presumptions, because whenever you're looking at tax brackets, you will not be taxed at 100% of your income at that top bracket. It's always going to be a gradual to the very tip top. During World War II, for example, I believe the top marginal was at the 90s. I think only one person in the United States possibly hit that. And so it goes back to, hey, when you retire, your income needs are actually going to drop down significantly, because right now, when you're building wealth, you're probably going to need the most amount of money to pay down your mortgage, pay off your student loans, actually contribute to your retirement. That's when you're going to be earning the highest monies. And that's when your top marginal tax bracket is going to be the highest. So almost universally, you want to wait until or at retirement, or when your income drops. But let me tell you, I got plenty of clients who are playing Monopoly IRL, and they're always going to have a high income, or they have a business that they're going to always have generate business dividends of some sort, or distributions, and they're always going to be at whatever the top marginal bracket is. And the answer for them is very different. It oftentimes is just stuff as much as you can into the Roth, because at this point you're always going to be in the top marginal tax bracket. So really, it's just a matter of figuring out math. It's not fun. It's not anything sensational. It's literally just, let's try to math it out.
Awesome. Thank you for going through that. And we have a bunch of questions coming in, so I'll make sure we get through as many as we can. Jane's asking or saying, tell me more about the insurance and the tax advantage bucket. What are those?
Hmm. Yeah, so these these are I guess technically called variable universal life policies, but they're usually on a private placement structure, and they normally have maybe 500 investment options, real estate funds, stocks and bonds, private equity, etc. And the reason behind this is basically to qualify it as life insurance. There's a test that you have to go through with the IRS called the 7-pay test. So you have to have a certain amount of life insurance above the accumulation in the policy. So these policies are designed to optimize that, to reduce the amount of life insurance just above the qualification so that you can accumulate money. As I said, if you put $100,000 premium into the contract like this, you would have $100,000 of cash value the first year. And that could earn 7 or 8% depending on the investment. And usually they pay the mortality charges off that. Very thinly priced, very low commission, all transparent. So you know where every penny goes when you put your money in. And a lot of high net worth individuals are using these. A lot of use them offshore, which I don't recommend. I think that you're probably better off just going onshore with them because there's less. I mean, it's in the code. They're all structured and people are taking advantage of them.
Makes sense. Ricky's asking, what is more tax efficient in a taxable account, an international or a total US index fund, stock index fund?
Trick question. Anytime that you're in a mutual fund, you are probably less tax efficient than if you are in an ETF. Um, but in all honesty, I think that once you get into a taxable account, I think you just need to be aware that you have what I call little anchors dragging at the bottom of your returns. So if you were to think about the types of distributions that you get from your accounts, you're having qualified dividends, you are having non-qualified dividends, you are having interest, and you just need to be aware. And oftentimes, although it's not that fun, if you pull a Morningstar report, heck, pay for a subscription for it. So that way you're able to really read into the funds. You might be able to try to figure out, okay, what is a little bit more tax efficient. But let me ask you all, like if you had some fund that was returning guaranteed almost like 30%, we're in pretend land here. And then you had another one that was only returning 10%. And for some odd reason, that's like the implied return. And one was, taxed a little bit more than the other one. That's probably not going to be your main concern. I think your main concern is what's my total return after taxes. Not to say that taxes aren't important, because taxes are 100% guaranteed versus the returns are only implied. But I think it's very important not to let the tax tail wag the return dog in this case. So really great question on, hey, should I be concerned about the taxes of an international index fund versus a US index fund? But I would go back to what is the return, and also hidden tax is your expense ratios. If you have a really expensive fund, you can consider that a performance tax. So these are all things that I would say a good investment advisor would be able to show you. But at the other end of the spectrum, if you want or have an interest in it, make sure to look into it, because these are actually very easy life skills to pick up.
Awesome. Well, we are at our time, but I want to do a lightning round to get through the questions we have here, and then we'll definitely, you guys have the emails here for Bill, and I'm sure Enpo, maybe you can put yours in the chat. So if there's others you can ask. But Gail is asking, yes, you can't have an HSA unless you have a high deductible health plan. Many of us do not. Any suggestions if we don't? Yeah, and Poe, anything that comes to mind. For me, I know typically it's sort of like you kind of have it or you don't available to you.
You'd be very surprised at what is considered a high deductible plan. But truly, if you don't have a high deductible plan, you don't have one. If your employer doesn't offer it, but you still qualify under high deductible, you can open up an HSA on your own. So just remember that.
Awesome. Stephanie was just asking about the backdoor Roth. I actually just linked to an article that goes into that extensively. Jane, how is cash balance distribution below the line? So just a clarification on how that's kind of below the line, I think.
That's going to be very, very long and convoluted. But bottom line is, it does involve paying taxes. It does involve trying to take out an asset from it. But happy to give you more details about it later.
Okay. Harvey, can you open an HSA if you're self-employed? What if you still have a previous HSA?
Well, good questions. Yes and yes. If you have a previous HSA, now if it's with an old employer, they may not let you put any more in that HSA, but you can always, to my point earlier, you can open up your own HSA. And a lot of the times when you're self-employed, I mean, unless you're paying for some Cadillac plans and you're just making a lot of money, you're probably in a high deductible plan.
And the high deductible, yeah, absolutely. Another HSA question. This was a really high yield point. Is it advisable to have an HSA if you do have medical issues?
Oh my God, that's such a great question. So we had a client. He read an article from a influential physician just saying, "Oh yeah, everyone should have an HSA. Everyone should open one up," or But then there were a lot of caveats to it, obviously. But you usually read what you want to. But it was great because we're on this call with this doctor, and he's telling us about how all last year his wife and him were sick. Their child's got a lot of health issues, and they're on some very heavy prescription drugs. They had so many surgeries, and he's like, "Oh yeah, but every year I'm maxing out my HSA," and I'm like, "What are you doing?" like, like how much money did you spend on this high deductible plan? Oh yeah, a few tens of thousands of
The answer
dollars.
is you probably shouldn't have it. You take a
Yeah.
look. Yeah.
Yeah. So bottom line is this, right? Always have your medical decisions come first. It's called health insurance. It's not called wealth creation insurance. That's a
Mhm.
different product. I make sure that if your family has any medical things, try to get a plan that's right for your family. That is so vital and so key.
Awesome. And then last we had a question, can you help explain the benefits of 1099 work, which is obviously can be pretty expensive, but extensive, excuse me. Um, but basically the benefits there that any like business expenses you can deduct from your income to give you a lower sort of adjusted gross income. Um, so this, and I did link to an article there as well.
We,
Well, this
we
was, oh
actually
yeah.
work, we work with a lot of emergency physicians who are 1099. So on our website, in My Financial Coach University, we have also a paper we wrote on difference between W-2 and 1099 pros and cons. So there are a
Perfect.
lot of advantages, obviously, being a 1099 from a retirement savings standpoint that you can accumulate less if you're an employee. But take a look at your blog and take a look at that paper. There are a lot written on pros and cons.
Awesome. Well, thank you all so much who joined and asked such great questions. Thank you, Bill and Enpo, for just a fantastic amount of information that is just so high yield and, like I said, actionable. So this was really enjoyable and fantastic. So thank you all so much.
We appreciate being on. And for everyone that stuck around to the end, thank you very much for your thoughtful questions. It's always nice to know that people care about their money and their money making decisions.
Awesome. Well, thank you all so much and have a great night.
Good.